Welcome to Your Money, Your Taxes, and Your Wealth. My name is Jarod Bloom, and I'll be your host. Today we're going to talk about investing in fixed income or investing in bonds. Today my guest is Michael Rabuffo from Gannett, Welsh Kotler. Mike, thanks for joining us.
Oh, thank you very much for having me.
So Mike, I wanted to start out because I think people are very familiar with stocks, or more familiar with stocks, but maybe not so much familiar with bonds. So I just thought we'd start out by talking about what is a bond.
Basically, a bond is like a contract where the issuer of the bond is essentially borrowing money from the investor, and in return, the investor is going to be paid back at some future point in time and will usually receive some type of interest along the way. And based on the terms of the contract and the risk of the issuer, the payments in return can vary.
Okay. So what you just said, it sounds kind of different from what a stock is. So could you talk maybe a little bit about what the differences are between stocks and bonds, and also differences between the stock market and differences between the bond market?
Yeah, good question. The bond market is an over-the-counter market, right? So with stocks, as most people know, there's the New York Stock Exchange. Most stocks in this country trade on that exchange. The bond market is really broker to broker, and that can lead to different price differences depending on who you're trading with and who you're transacting with. And as it relates to stocks versus bonds, they're two separate investment vehicles with two different types of risks and different return characteristics. But also, I think the most important thing about bonds is eventually you're going to get your money back. And because of that definition of principal and that recovery at maturity, the volatility in bonds usually isn't as great as the volatility in stocks, and therefore the return on bonds is not as great as the return on stocks.
So I thought you said something pretty interesting about how when you're dealing with bonds, it's a broker calling another broker, or as you put it, over the counter. So, and I know it's not quite like this today, but it's literally one firm picking up the phone and calling another firm and saying, hey, I've got a bond, I'm selling it for this price, are you interested? Or what price will you give me for it? That's very different than stocks when there's a central exchange. Can you talk a little bit about that?
Yes, the technology has evolved, so it's not just picking up the phone and one broker talking to another. There are various interfaces with which financial institutions communicate with each other to negotiate that price. And I think that's the key here, is negotiate a price. It's not just kind of a flat exchange price. There can be a give and a take based on the needs of the buyers or the needs of the sellers. Perhaps the investor or the buyer would want to pay extra for a certain type of investment to fit within their overall portfolio. And on the flip side, there also can be pressure on the seller because they may need liquidity at some point in time and may be willing to unload a particular security at a lower price than they would normally be willing to.
Okay, so a good analogy to me would be when you're trying to sell a house, because a house, you don't really know what it's worth until you actually have a buyer for the house. And the house can be negotiated, the price can be negotiated. So it sounds to me like it's a similar situation like buying a house. It
is. I think that's a pretty good analogy. I think just like the neighbor's house down the street that you may admire, you may want to purchase it, you can't purchase that house or that piece of real estate until the owner is willing to sell it. And when it does come up to market, there can be that negotiation process that I mentioned. But that is, in essence, kind of how the bond market works, where there's different types of issuers all throughout the country. Sometimes they are issuing bonds for specific purposes. But you can't always buy the security that you want whenever you want.
Now, there's different types of bonds, different issuers of bonds. There's U.S. Treasuries, there's corporate bonds, there's municipal bonds. So how does the pricing work for each one of those?
Yeah, so Treasury securities and corporate bonds are both federally taxable, whereas municipal bonds are usually tax-free. So you would inherently think the yield on the municipal bond, or the borrowing cost for that municipality, would be less because of that tax advantage. But they're basically three separate, distinct markets with different supply and demand characteristics, and those supply and demand characteristics will ultimately drive the pricing of those securities.
Yep, and so generally with U.S. Treasuries, they're considered the most liquid investment as far as pricing goes because there is such a strong demand for U.S. Treasuries.
Yes, and it's the largest, most liquid market in the globe, really. And that ultimately is why the yield on Treasuries is less than the yield on corporations. Corporations have greater risk than the U.S. federal government. And also municipalities are also different. Municipal bonds are have very little default risk, but again, they're apples and oranges. Very much depends on which type of bond you're talking about.
So you started to talk a little bit about U.S. Treasuries, about corporate bonds, about municipal bonds. Could you talk a little bit about what each one of these are, and for somebody who's watching the show, if they're an investor, maybe what they need to think about with each type of a bond?
Yes, and obviously, different types of bonds can have different tax consequences. So, for example, municipal bonds are federally tax-free. If you buy, if you're a resident of Massachusetts and you buy a bond from Massachusetts, it's also, the interest is exempt from the state income tax. When you look at corporate bonds and treasury bonds, those are both federally taxable. Corporate bonds would be ultimately supported by the company that issues them and supported by the revenues and profits of that company. The treasury bonds would be supported by the U.S. Treasury. And that is why often, in terms of safety and kind of default risk, U.S. Treasuries usually carry a much higher credit rating than most corporates or municipal bonds.
Okay, and when you talk about credit ratings, so if we could just talk a little bit about that. I know that there's typically there's Standard & Poor's, which is a ratings agency. There's Moody's, which is a ratings agency. Can you talk a little bit about the ratings agencies and how they come up with these credit ratings?
Sure. There's actually a third rating agency called Fitch. And basically these are the rating agencies that are responsible for analyzing and giving a kind of credit risk or a rating to any particular entity. Think of it much like your credit score. And that can fluctuate over time depending on your balance sheet and what you have as a homeowner or an investor. But basically the rating agencies are there to support investors in the market. But really they're public entities, they're public businesses that get paid to provide that rating service.
Okay, so a couple of years ago we had the subprime mortgage meltdown. Ratings agencies were kind of doing things where they were issuing their ratings on some securities that they called them AAA rating, which is the highest rating you can have. And then, of course, after the real estate market and the mortgage market kind of crashed, turned out some of these securities that were AAA rated really were not AAA rated. So could you talk maybe a little bit about what happened back then? And we have these same rating agencies going on today, and so is there a difference in how they do their business?
Well, there is, and again, as it relates to their methodology, I can't speak about that, but basically within these various types of instruments that they are giving their credit rating, there can be pools of instruments, whether it be student loans, mortgages, et cetera. And when they were looking at the overall pool, they could attest, well, how much of the pool is kind of high quality, how much is low quality, and they could give it some type of probability estimate for default. And they were really kind of looking at these different tranches, these different sectors within the overall pool. And unfortunately, the lower segments of this pool really changed, and the default drastically changed.
Now, the company that you work for does bonds, buys bonds and sells bonds. And in our conversations, you've told me that you do your own rating as well. You're not just relying on these ratings agencies. Could you talk a little bit about what goes into when you're trying to give a rating internally in your company, what you're looking for?
Sure. So as an example, let's say Massachusetts Turnpike. If you were looking to buy bonds that were issued by the Massachusetts Turnpike, you'd want to know kind of what's the balance sheet, what's the financial statements of that entity. You'd want to do stress testing to figure out if gas prices go up, what does that do to toll revenue? Same thing if gas prices go down, what does that mean? So, you need to do the research. I think there's a lot of different information available on the internet. But certainly that would be one of the ways we provide value for our clients is doing the credit research in-house.
Okay. Now, so you mentioned Commonwealth of Massachusetts and toll revenue. You also mentioned, the town of Acton. So these are municipal bonds, and I know your firm does a lot with municipal bonds and specializes in it. And with our clients, we're using your firm for their municipal bond portfolio. Just to talk about municipal bonds in general, one of the things that I found interesting in learning about this from you over the years is, for example, the town of Acton, which is a very good town, has a very good property tax base, versus, let's say, the Massachusetts Turnpike Authority tolls. If you buy those bonds, well, at some point you're going to try to sell those bonds, or you could hold them to maturity. But if you were going to sell them, for somebody who might be potentially buying them, they could be anyone around the country. And somebody who's around the country, they might not know the town of Acton, or they don't want to do the time to research the town of Acton. Whereas the Commonwealth of Massachusetts, whether it's the toll revenue or a general obligation bond, they'd be more familiar with that, which then leads to the topic of liquidity with bonds. So could you maybe talk a little bit about that?
Yeah, I mean, the municipal market, as an example, has over 50,000 issuers, right? It's comprised of general obligation bonds that are supported by the taxing power of the entity. So, for example, Acton is supported by property tax revenue. The Commonwealth of Massachusetts, the state of Massachusetts general obligation bond, is supported by income taxes within the state of Massachusetts. And then, of course, there's revenue bonds, which are backed by a specific type of revenue, whether that be toll roads, electric utility, water and sewer, what have you. But the overall municipal market has over 50,000 different issuers. And as I mentioned, some trade more often. As an example, Acton wants to build a new playground. They may issue a couple 100,000 of bonds, which will probably be gobbled up by local residents and people familiar with the town. But then those types of bonds may not trade because the most common investor holds those bonds to maturity. If you think about the state of Massachusetts as a larger entity, their bonds might trade more often. But again, it really depends on the state, the town, the revenue source as well. It all can change. And the liquidity, because it is a broker-to-broker market, liquidity depends on what you own and the size of the issuer.
Okay. So sometimes I'm speaking with clients, and when we talk about investing in bonds or investing in fixed income, they don't sometimes understand that the price of a bond can go up and go down. Now, you talked about possibly holding a bond to maturity, but then you could also sell a bond before maturity. So could you talk a little bit about how bond prices go up and go down, or why they go up and go down, and what an investor should think about if they're investing in fixed income, and whether they should hold a bond to maturity or whether they should sell a bond before maturity?
Sure. So, bonds are often called fixed income. And most often bonds have a stated coupon rate or stated amount of interest. Well, if a certain entity is paying you 4% in interest, the value of that cash flow, the value of that 4%, can fluctuate with market rates. So for example, if you're getting paid 4% and the market rate is now 3%, you would see the value of your investment perhaps rise north of par, north of 100. If the market rate all of a sudden gets to 5%, your 4% investment now may be less than that. It might be less than par. So that's largely how interest rates can influence the market value or the price of your bonds. But obviously those fluctuations, if you hold them to maturity, you're going to get your money back, aside from the issuer defaulting. You're going to get your 4%, and eventually the bond will mature at its maturity date. But certainly along the way, the market value can fluctuate with interest rates, depending on what they are at the time.
Okay. So speaking of interest rates, so last week the Federal Reserve raised rates. They announced there's going to be more raises in the coming year. Can you talk a little bit about what the impact of that is on bond prices, or what it's been so far, and what you think going forward? Now, we're not going to make any predictions about future interest rates, because I know the way you manage, or your company manages bonds, as well as our philosophy, is you can't predict reasonably what interest rates are going to do and what the impact is going to be as far as prices. But in general, when interest rates rise, bond prices fall. So could you talk a little bit about that? And gee, if interest rates are rising now, does that mean we should invest in bonds at all?
Correct. Yeah, I think the general investor thinks that the Fed controls all interest rates, and really the Fed really controls the federal funds rate, which is really the short-term rates that banks lend to one another, and really more directly correlates to money market rates or the CD rates you would get at a bank. But how longer maturities react can be quite different. Corporate bonds, municipal bonds, treasury bonds can actually move differently. And as an example, in July, after the Brexit, the 10-year treasury yield had gotten as low as 1.3%. And then as we rebounded from the Brexit and the kind of global economy kind of improved, and certainly domestically here, we were getting closer to the election, we were getting closer to the Fed meeting in December, the interest rates on the 10-year had actually moved up. And the 10-year treasury, just like stocks, actually does change. You can see it on CNBC. The yield on that 10-year treasury bond can fluctuate. And the day before the election, as an example, the 10-year treasury was 1.85%. So it literally had increased from July about 55 basis points or 0.55%.
Okay.
As of this morning, it's about 2.6%. So to your point, the Fed tightened last week 25 basis points, and here we are, the 10-year treasury is 1.3% higher in 5 months. So that's a very good example of how the Fed funds rate only went up 25 basis points. It's in this 50 to 75 basis point target. But meanwhile, in just 5 months, you've seen the 10-year treasury increase by 1.3%. Quite different.
Okay. So the bond market sounds like it can fluctuate quite a bit, and in fact, it does fluctuate quite a bit. From our perspective as wealth managers, we feel like risk and return are related, and that's just simply a fundamental fact of investing, whether it's investing in stocks, whether it's investing in bonds. So sometimes we'll see, or we'll have people come to us and say, I'd like to get more return with my bonds, and there's something called the high yield debt. Do you want to maybe talk a little bit about that and how with higher returns maybe there's now more risk?
So the amount of interest or the amount of yield you would earn on a bond is determined by the risk, either maturity risk or credit risk predominantly. So if you own a longer maturity bond, a bond that pays out in 20 or 30 years, you expect to be rewarded with more yield because you're lending your money for 20 or 30 years out. The same thing can be said if you lend money to a lower rated entity, whether it be high yield, or literally as you start off from AAA to AA to single A, as you go down the credit scale, investors expect to be rewarded with more interest or more yield because of the increase in risk, the increase in default, and the increase in kind of volatility.
Okay. An example that I tend to use with clients about that topic is using the example of Kmart and Walmart, and I'm just picking them, just in general. Walmart, the largest retailer in the United States, if they want to issue bonds to borrow money from investors, let's say they want to build more stores and they don't want to use their cash, so instead they're issuing bonds. Maybe the market says, well, we only want or demand 3% interest rate from you, whereas Kmart, where Kmart's business has not been doing well, especially with the rise of Walmart, if Kmart wants to borrow money, they probably need to offer a higher interest rate than Walmart at 3%. So you could get a Kmart bond maybe at 5% interest. So it's got a higher interest rate, but now there's a little more risk there because is Kmart going to go bankrupt or not? And we have no idea, but just as an example of how interest rates are tied in and risk and return are related.
Yeah, absolutely. And that's, perhaps you have a certain entity that's looking to rebuild and branch out and build a lot of stores or a lot of different offices. What's the impact on their overall balance sheet? How much debt are they taking? If they're over leveraging themselves, you would expect their credit rating to suffer and go down from that, whether AAA, AA, single A, and that would impact their cost of borrowing. That would impact their cost of capital, and ultimately how the market perceives their bonds.
Okay. So we've mentioned a couple times about the election that happened last month. So starting in January, there's going to be a new president. There's going to be a Republican-controlled Congress. What's the impact of all this on the bond market? What's been happening since the election, and presumably that's going to continue. But can you tell us a little bit about that?
Sure. So the bond market and the stock market have been pretty optimistic on kind of a Trump presidency. As you mentioned, he's going to get sworn into office next month. But the market has already reacted since the election. The stock market, of course, is higher. The bond market is pricing in more growth and more inflation. And kind of looking at Trump's agenda, you can see the potential for tax rates to be lower, his effect on corporate America to benefit growth and employment in the United States. Whether or not we all see this really depends. Even though it's a Republican-controlled Congress, there's still checks and balances in this country. But the market has moved a lot. Both stocks and bonds have really moved quite higher as we price in more growth and inflation for 2017.
What's interesting is we've got clients who their portfolios have gone up. The stock market's gone up, so their portfolios have gone up. And now it's toward the end of the year. We're talking about maybe you need to do some trades where you're taking some of these gains that you've had, and then you have to turn around and invest in something. And in order to keep your portfolio balanced, you take the gains on the stock side and you go buy on the fixed income side. And I think that can really make a client, just say, I'm not sure if I want to do that because bonds are down, and why do I want to buy something that's down? And there's this Republican-controlled Congress, they're only going to go down even further. I mean, can you talk a little bit about, even if there's a Republican Congress, even if they're doing all of these policies, which so far has made the bond market, or I should say the bond market has priced that in and has gone down, does that mean you should continue to invest in bonds?
Well, I think the ultimate answer is depends on the investor, depends on what your goals and risk tolerance are. Is. I think you should, talk with your financial advisor on kind of the best course of action, whatever that might be. But stocks and bonds are different. They have different measures of volatility, different risks. I think the bonds, even if you're holding bonds to maturity, as long as the issuer doesn't default, you're going to get your money back. You get that stated amount of interest. So, usually bonds have less volatility than stocks. And I mean that they have less upside, they also have less downside. But it depends. It depends on what you're owning. And I think bonds should not compete with stocks. There's probably a space for everyone at the table, whether it be stocks, bonds, even cash.
Yeah, and in general, with our clients, we develop balanced allocations. We're not trying to guess or anticipate or project where the stock market or where the bond market is going to be going. And so I think it's important for clients to have balanced portfolios. And yes, unfortunately, if the bond market has gone down, the fixed income part of their portfolio has also gone down a bit. But the equities in their portfolio have gone up and have more than offset that. So there's a balance. You're never going to get it right all the time, and you're not to have both bonds and stocks going up at the same time and trying to guess exactly what's going to happen or when that's going to happen is difficult, if not impossible, and that's not what we're trying to do. So it's interesting. You said something about as long as a company or the issuer of a bond doesn't default, you're going to get your money back. So could you talk a little bit about defaults and how common is that?
Well, there's thousands of different entities, both in the municipal market and the corporate market. Municipalities generally have a monopoly on the geography and the social services that they cover. So the town of Acton, whether you like paying your property taxes or not, it's not going anywhere. So the default rate in municipal bonds historically has been very low. The recovery rate tends to be very high.
When you say recovery rate,
if in fact there is a distress or a bankruptcy, the amount of money you would expect to recover, the amount of money that you would eventually get paid back. The default rate in municipal bonds is historically less than 0.1%.
Okay.
The default rate in corporate bonds, again, corporate bonds don't have a monopoly, or most corporations don't have a monopoly on the services they provide. the default rate on corporate bonds can be a little bit higher, closer to 2% historically on average. But again, it depends on what you own and which types of instruments you're invested in.
Okay. And I think, in the public's mind, when there is a default, that makes it into the newspapers and everybody's focusing on it. And I think people are familiar with General Motors, the city of Detroit, and I'm not sure if city of Detroit officially filed for bankruptcy, but when those things happen, I mean, that's really it captures the public's imagination, and they say, oh my gosh, are my bonds going to default? Am I going to lose my money here? And this is supposed to be a safe investment. So, that's why I think it's really important for people to understand how realistic it is for a default to occur, and especially with the difference between municipal bonds, corporate bonds, and so on, the different categories of bonds.
Yeah, no, absolutely. I think when you have those types of negative headlines, they can affect investor sentiment. They can impact the demand for certain instruments. So certainly something like a bankruptcy in Detroit or somewhere in California, that does not directly impact Acton. It doesn't impact its financial status. But certainly maybe that investor who was going to buy Acton bonds or Massachusetts Turnpike bonds, maybe now because of that kind of perceived headline risk, would want more yield or more return for that investment.
And by the way, you just mentioned about potentially buying Acton bonds. I think earlier I said something about, we talked about liquidity, and maybe Acton bonds don't have as much liquidity as Commonwealth of Massachusetts bonds. Now, I'm not suggesting people should avoid Town of Acton bonds. There's certainly lots of good reasons to buy them, and it just depends on the right investor to buy those bonds, and you want to make sure that you understand this issue of liquidity. And hey, if you're buying a bond and you're going to hold it to maturity no matter what, that might just be a fine bond to own. So could you talk maybe a little bit about that and how some investors maybe buy bonds and hold it to maturity, whereas other investors may not hold it to maturity and may want to sell the bond before maturity?
Sure. So I think when you hold the bonds to maturity, you're obviously going to get your money back, and you're going to get the rate of interest along the way. And quite frankly, that's why most people own bonds, is for that kind of measure of safety and getting their money back, and also some interest along the way. But as I mentioned, the market value and the price of those bonds can fluctuate over time. So you want to feel comfortable with how much that fluctuation can be. You also understand the liquidity. If you own a 20-year bond and you're into it for 5 years, are you going to be able to get out of it in 5 years? So these are things you want to talk with your financial advisor and understand not only what the risks are of these different investments, but also kind of your liquidity needs.
So earlier you mentioned something about student loan debt, which is kind of a pet peeve of mine, or a pet topic of mine. It's actually going to be another topic for another episode that I'm going to talk about that. So I was just wondering what your thoughts were from a fixed income standpoint. Now, so there are people who are investing in student loan debt. Could you maybe talk a little bit about that, and what the implications are with the student loan debt situation in this country?
Yeah, sure. I mean, there's asset-backed securities which can be packaged together and group student loans or car loans together, and then these different pools are sold off to the marketplace. But I think you got to understand what's going on with the pool, how many students are within the pool, kind of the different risks of those students. Certainly as the cost of education goes up, you have to ask, how much debt are these students taking on to support those higher education costs, and then what's the risks within that pool. And again, these are thousands of individual loans that can be in a pool. So I would encourage investors just to be cautious, but certainly look behind the curtain and see what makes up the pool.
And when you start talking about pools of debt like this, of these asset-backed debt, that starts to sound to me like what we had with the mortgage situation and subprime mortgages. And so when there's debt that have these pools, I mean, how transparent are those pools? And you know, I mean, we just went through this crisis a decade ago, less than a decade ago. Is this the same thing? I mean, I'm not asking you to make a prediction, but it just sounds like it has a lot of the same characteristics. Could you address that?
Well, I think the characteristic is you have a pool of hundreds or thousands of different loans, and there's different risks within those individual loans, and I think the investor needs to be understanding of what those different risks are and look at the breakdown of all the different loans. For example, within student loans, you might want to know, well, what's the kind of credit score? How many students have credit scores that are 700 and above? How many are below 700? How many of them are below 500? So again, student loans can be different than mortgages, can be different than auto loans, but I think the investor needs to be aware that they are made up of all these different types of loans.
Okay. So yeah, so what I'm getting from you is that, you know, fixed income, the bond market, it's pretty complicated. There's a lot of different segments to it. There's municipal bonds, there's government bonds, there's bonds based on student loans, there's bonds based on mortgages, it's a pretty diverse field out there. And this is, I think, a lot different than the stock market. I think people are familiar with the stock market, they get it. I own a share of a company, that's great. But the bonds, this is very different.
It is, and the each market can be different. I mean, the corporate bond market's about 8.4 trillion. The U.S. Treasury marketable securities is about 13.4. Municipal market's only about 3.8 trillion. So there can be different markets, and certainly you need to understand the complexities of each.
Okay, great. Well, thank you very much. And that's all we have for this week, or this month, I think. And we'll be back for another episode. Thank you for joining.